So I'll be introducing our next panelist. This is our next speaker. This is an investing solo session by Mr. David Cowan. So David is an African economist, or has been the African economics at Citi since July 2007. Prior to this, he worked at the Economist Intelligence Unit for a total of 8 years as senior economist for Africa and the director of the Middle East and North Africa team. Before joining the Economist Intelligence Unit, he worked for 6 years as the principal research officer at the Bank of Botswana, the country's central bank. There's a lot to say about him, but because we don't have so much time, I'll pause here. Again, please a reminder that we should be a bit quiet for our next session. Thank you very much. And can we give him a round of applause as well?
Which microphone am I going to use? Okay, time is tight, so we'll plow on in terms before the bell of doom catches up with me. In true Nigerian style, I guess the way to say it is all protocols observed, and then we move on into the discussion. Now look, I'm going to talk to you at a pretty quick pace here. And what I'm going to talk to you about is an overall picture for Africa, right? There's lots of different countries in Africa. Some fit the picture, some don't fit the picture. But there is a narrative that has emerged, I think, over the last few years that is important to understand, because for many of you invested in Africa, the last few years have actually been quite difficult, right? Currencies have collapsed around you. You've had a lot of issue on return. So it's trying to understand what's driven that and where we are now as we go forward. So look, to understand where we got to in 22 and 23, you have to go back a little bit to a period when I was a much younger man and I didn't have all this gray hair and things like that, right? So I was wandering around Africa in the late 1980s, the early 90s, writing my PhD, and we were living through at that time a crisis, right? A crisis of default and currencies collapsing. Okay, for some of you with longer memories, you'll remember that the last time the CFA was devalued was late 93, early 94. Right? We've had all the stability since then, but we have lived through this once before. And out of that currency collapse and those defaults actually started to emerge this new growth story, which ultimately led to a lot of people in this room probably being attracted into the continent through the Africa Rising story, right? And that started to gain. But the problem with the Africa Rising story as it started to gain momentum was, first, it was probably overhyped, right? The only battle I've ever won at Citi is that there's no such thing as an African middle class, right? There's an African consuming class and there's an African upper class, right? But there's no middle class as such in any large numbers, right? But the problem for the Africa Rising story was it started to attract in a lot of capital. So you see two things. In 2007, Gabon and Ghana became countries that went to the Eurobond market. They were the first time we've ever seen African countries come to the private capital markets and be able to borrow. They were followed by a whole bunch of other African middle-income countries, Kenya, Cote d'Ivoire, you even see Zambia issuing, right? All these countries start to raise capital. At the other side, you've got this wall of money coming into Africa from China. This is the first time, well, not quite the first time. Remember that China lent to Africa in 77 for the Tazara Railway under Mao. But basically, this big wall of Chinese capital started to come in. So you've got this growth story going ahead, and there's a lot of money available. So what you tend to see is that African governments start to run bigger and bigger fiscal deficits. And the fiscal deficit is always the root of an African economic problem. It was the root in the 80s and the late 70s. So none of this mattered for a little while. But then two things caught up with Africa in recent years. The first was COVID. So you were on a declining fiscal trajectory, and suddenly in 2020 COVID hit. And look, everyone in the world was running big fiscal deficits, so you could run even bigger fiscal deficits. But as you came out of this, as the continent came out of this, something unexpected happened. Vladimir Putin invaded Ukraine. That created a global inflation shock that pushed up global interest rates. And suddenly, this borrowing was starting to look problematic. So what happens? In 2021, Zambia defaults. Ghana defaults in 22, and then Sri Lanka also defaults. And for much of 22 and 23, the market started to ask questions. We've given Africa a lot of money. These countries have defaulted. Who will default next? And the line actually went from Sri Lanka to Pakistan, then it came back to Kenya, then it went to Egypt, across Tunisia, down to Nigeria. Nigeria had been quite a complicated case in terms of whether Nigeria could ever default. Now, the point I make to people about defaults is that in some ways, it doesn't really matter. Okay? Now, if you own the debt, it matters to you, right? But if you live in Lusaka, if you lived in Accra after the default, nothing really made any difference. You woke up, the sun was still shining, you went to work in the morning, right? You enjoyed yourself. Now, what does happen, though, when a country defaults is its currencies tend to get crushed, right? So you see the Kwacha collapse, you see the Citi collapse, you see the Sri Lankan rupee collapsed, right? Remember, for some of you in Kenya at this point, the Kenyan shilling was rapidly heading towards 160, right? And people I spoke to in Nairobi at the time told me it was heading to 200. So your currencies collapsed, except we had a big problem in Africa. Two of the biggest central banks, the Central Bank of Egypt and the Central Bank of Nigeria, refused to let their currencies move. And so when you don't let your currency move, what you have is this huge backlog of FX building up inside the country that you can't get out. And so we were in this situation by late 23 where you probably had $10 billion trapped in the Nigerian market and another $10 billion trapped in the Egyptian market. And there's some other places. Ethiopia, we had money trapped. We still have some money trapped in some places. But that was the problem. Now, look, this whole logjam broke in early 24. What happened in early 24 was quite simply that the markets believed that the Federal Reserve would cut interest rates. As interest rates were cut, basically what you saw was that Cote d'Ivoire came back to the market, Benin came back to the market, so they had access to Eurobond money back. And at the same time, China, who had stopped lending after the COVID crisis, started at the September 24 African Forum for Chinese African Cooperation, started to give money back, $50 billion over 3 years. But the big thing that happened was that ultimately the central banks of Egypt and Nigeria gave up the ghost and devalued their currencies. So the Egyptian pound goes from 17 to where it's trading now around 51. The Naira goes from 464 to where we're trading now, 1,500, right? Even by my standards, these are big moves. Look, you can go back and say, when did the Naira last move this much? Go back. Abacha kept the Naira at 22 to 21 to the dollar. And then when Abacha left and we moved into the Obasanjo and the shift in Nigerian democratic rule, the Naira had already moved to 100, right? So it moved from 21 to 100, okay? But you've only seen these sort of moves, most of us, once in our life, okay? Now, they are incredibly brutal. They push up inflation. Psychologically, they are extraordinarily disruptive for the people in the ground, right? You've got this idea that going to London or doing something in London cost me X Naira. Now it costs me Y Naira, a lot more, right? It's a big, big disruption. But it does ultimately drive the change. So you see the economies start to adapt to it, and they're starting to grow. And we're seeing that now. The Nigerian economy is picking up. The Egyptian economy is picking up. After the defaults, bizarrely enough, in places like Zambia and Ghana, the economies have actually proved super strong. You look at Ghana at the moment. This is a country that defaulted 2 years ago. It's growing at 6%, has a fiscal deficit of under 3% of GDP. It's running a large current account surplus, and depending where the CD ends up at the end of the year, debt will probably be under 50% of GDP. That is a huge turnaround. So what we've got, we've had this big adjustment, this big reality call, and now it's running into a situation where actually across Africa, we have quite positive terms of trade impacts, right? So think about it in Ghana's case. Gold price high, cocoa price high. That helps drive the current account surplus. At this moment, the oil price is relatively fairly balanced for Africa. A $60 to $65 oil price doesn't penalize the 8 oil exporters, but it does give some boom to the oil importers, right? They can keep the petrol price at between $1, $1.30 a litre, which is good for consumers, right? If the oil price goes to 50, you're going to see problems emerge a little bit, right? Angola, the CMAC countries, less so in Nigeria because of the scale of the adjustment. But obviously that will benefit the oil importers. But let's see where the oil price goes. Now, what this would tell you is that this whole adjustment potentially paves the way for a new Africa rising story. You could see very good growth over the next few years, having gone through all this pain, right? I've seen it once in my life, and I don't see why. And if you want the picture of it, I really do wonder sometimes whether Nigeria under, and I'm going to make an assumption here that Tinubu will win, right, early next year, right? Nigeria, in the next few years, will start to resemble a bit what happened under the Obasanjo administration. So the first Obasanjo administration, things were pretty dire, right? But by the time we got into the second Obasanjo administration, that's when the Nigerian economy boomed from 2003 to 2007. And it wouldn't surprise me if that doesn't play out over the course of the next few years. But remember, this time, it's playing out with some super important structural changes. For example, think about it, they're recapitalizing the banks. They have effectively, you've seen this change that's kind of gone under the radar in Nigeria, that the multinationals have sold their onshore operations completely. They're only operating offshore now. How this new wave of indigenous Nigerian oil companies plays out will be fundamental in thinking about where you think the economy will go. So the structural changes are slowly happening. And remember, the structural changes for a man who works for a bank are happening in the banking industry. Right? Citi will be the last foreign bank standing in Africa. The European banks are gone. What you're seeing is the Moroccan banks come down, Nigerian banks go across, the Kenyan banks go across, and the South African banks coming up. They will be fighting for the future. This year, I would suggest to you that Standard Bank of South Africa will earn more in the rest of Africa than in South Africa for the first time. So this whole story is changing. There will still be some wobbles. The reality is that Senegal could default, right? But think about Ghana and Zambia, it doesn't really matter so much, I would argue. There are still some currency adjustments to come. The big ones are Mozambique and Angola, the two Lusophone, and then obviously the biggest one that doesn't really impact on many, Malawi. The Malawian kwacha is going to have to collapse at some point, right? So there's still some things to play out here. But the adjustment we've seen is starting to give us hope. Now, the final thing I'll just say on all this is enjoy the next 6 months, but we've still got to get the currency story right. If at the end of 26, Naira's trading at 1,500, Egyptian pound at 51, Kenya shilling at 130, kwacha at 24, Cedi at 13.5, then you know that that stability is starting to be maintained for too long, and it can start to be the seeds of another problem coming forward. But in the moment, we're on this upturn, and I suspect it's got quite good legs for the next few years. But let's worry about the currencies when we get there next year, right? But that's the biggest thing we have to have in the back of our minds. Can central banks adjust their currency regimes going forward so that we can take this boom forward? Thank you very much.